Hi there, welcome back to my channel. Today I want to talk about GameStop. This has been one of the most buzzed about stocks of the last week, and I think it'd be a great lesson for us to understand what are the things that are driving a stock like this in terms of the stock price movement, and then also fundamentally, what's the bull case for this story if there is one, and what might the bear case be? So I want to kind of present both sides, but I think I should start by saying first and foremost, I'm a technologist. I'm not a investment advisor, so nothing what I say in this video should constitute any investment advice, should not be taken as an offer to buy or sell any security that's mentioned here. I'm not charging a fee for advisory services. I'm not managing funds on behalf of clients. I'm simply an investor and a technologist who really likes talking about stocks and understanding and analyzing company fundamentals and in some cases the technicals as well. And so with that said, let's talk about GameStop a little bit. I think what's gotten lost in the whole discussion around GameStop has been pretty much the short interest in the company. It's been kind of viewed as a meme stock. Actually, it is kind of the meme stock, right? And in recent weeks, it's kind of reemerged as one of the most highly traded, or I would say even from an options perspective, most active security symbol or ticker symbol in the market. Everyone's been talking about GameStop, and I think a lot of that has been driven by kind of the cult of fandom around the character known as Roaring Kitty. And some of you guys may know who Roaring Kitty is, but if you don't, there's a movie that was made about him and this whole GameStop craze called Dumb Money. You can go check that movie out if you want, but it basically talks about like how in 2021, I think it was, a bunch of people on Reddit decided that they wanted to kind of stick it to the man, I guess you could say, and try to prop up the stock of GameStop and just sort of be a buy and holder of the stock so that the shorts couldn't profit from the stock price going below what the shorts thought the intrinsic value of the company was worth. And this kind of led to this whole kind of Robin Hood, GameStop, Reddit sort of phenomenon that kind of took the market by storm back in like 2021, 2022, I think it was. And then after that whole kind of craze died down for a bit, and then Roaring Kitty uh, kind of like got out of the public eye for a while, and then he's been kind of gone for the last 3 years. But all of a sudden, in the last month or so, he's kind of reemerged back on social media, and he starts kind of like talking about the stock again. And just last week on Friday, he held his first live stream after so many years being offline, basically, and he had something like 650,000 viewers live on his live stream, and he talked about GameStop stock, and it kind of, I'm not sure if it went according to plan, but the stock ended up selling off pretty significantly. And I think it was something like 40% loss on that day from the time he announced the live stream to that time that the live stream ended. The stock sold off pretty significantly. So was that a success? Like, was that just to pump the stock? Like, people are wondering, like, like what was the whole reason for that? And I think it was, I can't really speak for Roaring Kitty, but I think his name is Ken Gill, if I'm not wrong. But I think what it did was it actually drew more eyeballs to the actual fundamental story of GameStop. And I thought it was kind of brilliant. And I'll go into that with like this example here that I'm sharing on the screen. On the left-hand side, you'll see this is my portfolio, my application that I use to kind of help me build diversified portfolios and test out different investment strategies. I definitely encourage you guys to come and sign up and use the platform because it is pretty cool and it's a great learning tool. It's all simulation. It's not, You're not risking any real money in this platform. There's no buying or selling of any securities. It's purely a way to like kind of practice your modern portfolio theory. But one of the cool features we recently launched was, or we're going to be launching very soon, is this whole candlestick chart. And this is a technical chart that technical analysts use to kind of gauge the like intraday price movements of a stock. So it gives you some more detail than what the kind of like more traditional line chart would give you. Because if you kind of zoom in here, right, like what you'll notice are these what's known as candlesticks. And you see these green and red candlesticks. And what you'll also notice is like they have different sizes. So basically how this works, here, let me just try to zoom out for a second and grab a section that will illustrate this. So what you'll see is that like when the thin line shows the intraday movement. So it shows you from the high to low. So that's the range at which the stock traded within a single day. And then the bottom of the filled in part was I think the top of the the bottom was the open price and the top was the close price. So let's say on this day, what day was that? The 13th of May, the stock opened at $26. It ended up closing at $30, so about $4 more. But in that time, it touched as low as 24 and as high as 38 before settling on a close price. This also happens on sell-offs as well. So it might have opened at 40 and then closed at 39. And in that day, the next day, it would have traded high and low, as low as 31 and as high as 42. So the thin line kind of shows you the range, sort of the intraday volatility, like how wide the opinions were for that day of what the stock is worth based on who's buying and who's selling. And then the filled in part of the candle is kind of telling you like how much of a consensus there was around the ultimate price in terms of how it opened and closed. So you'll see like there's these different shapes and sizes of these different candlesticks, and some have like more wild or like, a wider range between the high and low, and sometimes they're more of a tighter spread, you could say. So this is a cool new feature that we have in our platform because I think some people do really want to like combine both fundamentals and technical analysis when they're doing stock market research. So we've got this feature for you guys, and this is going to be really cool. So let's look at the stock. So essentially, once Roaring Katie started mentioning or started kind of like reemerging online, people took that as a signal of like, oh, GameStop's back. Like they're going to start like, trading the stock more, trying to support the price. And of course, this also caused other people to like start wanting to short the stock again, thinking like, oh, these guys are definitely overbidding this price. It's like the company can't be worth this much, because if you look at the company's fundamentals, like there's no way the intrinsic value of this company is worth as much as it's currently trading at. So people want to short the stock, right? And so when you short a stock, you're temporarily like borrowing someone else's shares, and then you're going to give them back those same shares. But in the meantime, you're going to give them back the shares at like the new price. So if you borrow the shares at like, let's say 50, and then like you return the shares back at 40, like I guess you could essentially make the profit between 50 and 40, and the person or the institution that you borrow the shares from still has their shares. So it's a kind of a derivative play to kind of like, it's an option to like go long or short on the stock without actually buying the stock. But if you're wrong and the stock goes higher, so you borrow at 50 expecting that it'll go down to 40, but it ends up trading up to like 60 or 70, then when that contract is expired, then you have to buy the stock because the price is higher than you thought it would be, and then you have to pay even more. So it can be a way of basically like they're trying to catch the short sellers essentially like offsides a bit and force their hand to buy the stock, which would then push the price even higher. So it is a very, very risky thing if you don't really know what you're doing to go like short on a stock. And that's kind of what the whole meme craze has been around. It's like kind of like the individual retail investors are basically facing off against the like hedge fund types and like the kind of like much more sophisticated investors, the institutional investor traders. So that has caused the stock price to kind of decouple from the fundamentals. But I don't think it's necessarily completely random, and I don't think it's totally gambling. And I'll try to explain why. First of all, let's look at the technical chart of this company and let's analyze it from starting in 2023 until today, right? What you'll see is that for a pretty long stretch of time, the price has traded between a defined range. That defined range has been around the $20 mark, although in the last sort of like year or so, it had trended lower. But the support level was $10, so we never saw the price drop below $10. It got as low as $10.01, but that was your support level, so it wasn't going below that. And at the same time, there was a resistance at around, let's say, 28, 29, 28, $27, right under $30. So you're within this range between $10 and $30. Now, on an absolute basis, that doesn't sound like much, but on a relative basis, that's like a pretty big difference. You could be valued at $1 billion, $2 billion, or $3 billion, and that's a huge range. But that's what that is. It is what it is. So that's kind of where it traded, and then it had been sort of trending downwards as well. So the range went from between let's say 15, 17, 15, 16, 17 to 27, and then it started dropping below the $20 range and started trading within a $20 to $10 range, right? Except for, I mean, all of which was true up until the recent time, the last month or so, when the Roaring Kitty and the meme and the sort of the fan base started bidding up the price pretty aggressively. And so now you're starting to see it finding a different range where it's at, like right now the price is at $28. So after the live stream from Roaring Kitty and the sell-off, the price closed at $28, which was actually where the prior resistance had been, if we look back, right? So we're now at that resistance level. But we've also seen that the price has closed much higher in the previous few weeks. So if you're looking at it from this new level, you might see that the range has increased. I mean, it has gone higher. The support level now seems to be around the $20 range, $20 support level, and it's going as high as, in some cases, near 50. So the between $30 and $40 range is kind of where the stock is currently trading. Right now it's below that at 28, but it's very likely that it could trade within that range. I mean, not saying very likely, but it's completely possible, which would represent a higher point than it had been in the most recent past, last few years, which is interesting. Now, all of that is just to talk about kind of like one side of the market dynamics, which is purely on this sort of short selling and people trying to determine what is the intrinsic value of the company, what is it actually worth, and is it overvalued or undervalued? Is the market overvaluing it or undervaluing it? If we look at the company itself, first thing, and I think this is part of the like sneaky brilliance of the Roaring Kitty live stream, is that it got people to to pay attention to GameStop again, because GameStop just reported its quarterly results, and the quarterly results weren't great. It had less revenue this year versus last year, so it's already on like a year-over-year basis. It's like it has less revenue, I think. So that's not that good. It's trending. It's declining. It seems like it's peaked and its total revenue is starting to fall a bit. So that's not really a growth story for GameStop. So that's kind of what got people to kind of initially be pessimistic about the company and say, oh, this company is starting to it's no longer growing, it's declining, and maybe that has something to do with more of a macro or more of the industry-wide challenges that video game industry has been experiencing. I mean, there's different theories for that. Like I think the biggest one is around like mobile phones, smartphones. Mobile gaming kind of changed the landscape of what gaming is about. Like it went from being these like $60 or $70 games that you'd buy and you needed like a console and you'd play on your PlayStation or your Xbox, and there'd like be this big story or this open world and really cool graphics. But it became looked at as like a premium experience, and then people started going into a free to play experience where they're just playing Candy Crush and other games on their phone for free. I mean, they're still games, but they're definitely not as fun as like the traditional games have been. But still, like you can't play two games at once. Like you can't be scrolling TikTok and like Instagram and Facebook and YouTube and also having a game controller in your hand at the same time. So like, it's hard to play Xbox and watch YouTube and TikTok and everything else. So basically the competition for users' attention is like very fierce. And that like the competition for screen time is like it's like some very big companies are like battling for that, right? Like Facebook and ByteDance and Google, and like that's putting a lot of pressure on the video game publishers who take sometimes years to develop a game, and then like there's no guarantee that it will be a success. So it's like this huge bet. Like you're investing a lot up front and you're hoping that people will like your game and you'll be able to make a profit from it. But it's become sort of a cyclical thing where like, you are relying on like the release schedule of new games to come out. And GameStop, like if you look at the history of their revenue, like it's very much tied to the release of new consoles or new big titles like, Halo or Call of Duty or Grand Theft Auto or, Mario, Nintendo, PlayStation, Xbox. So like if there's not you really have to kind of look at the release calendar, and like that will really tell you the story of like what GameStop's revenue is projected to be. Because other than those big releases, like, throughout the rest of the year, it's sort of a long tail. Like you're kind of like people are looking at the back catalog, maybe they'll buy a game, but you get these big, in terms of the actual revenue, you get the big spikes typically around in terms of GameStop, their first quarter, which I guess would probably have their holiday season. So in the holiday, like towards the like last part of the year, during the holiday months is where like a lot of the big releases come out. You also have people like buy Xboxes and PlayStations as gifts and stuff. So it's very seasonal or cyclical in that sense. So it's not. Is it a great business? I mean, it serves a niche and it definitely has its place, but it's struggling with some larger factors as the industry itself has been evolving, and sort of like the competition for basically like filling your downtime or your free time or like trying to alleviate boredom is so fierce. And all these different companies, from short form video companies to freemium free to play games to just like playing games that you already own for longer and just like not buying new games as much, right? Like people will still they can play games for hundreds and hundreds of hours, right? You could still play an online game for a long time, which is great value from a consumer perspective. Like it's from a price, like from an entertainment per dollar spend, like you get a lot more hours out of a great game than like maybe like a movie or something. But still, like there's so much entertainment now available online. It's much more difficult, and the cost to produce the games is going up. The cost to buy the games is going up. So it's tough. I mean, it's definitely a challenging business to be in. That said, the company's CEO, Ryan Cohen, has made some moves, and the company announced its quarterly results. And although the results financially weren't great, I think what was buried in some of those results were some of the statements and other filings that the company published on its investor relations website. So I think this kind of goes into what Roaring Kitty wanted to like draw attention to. It's like he wanted to like, I think he, without saying it, he got people to start looking at the company more and realizing that GameStop had just like released some of these statements, and they've essentially announced, the big news is that their new CEO, Ryan Cohen, is so he's taking no compensation, so he's not getting paid, but he has already 12% of the company's shares outstanding, so he's the biggest shareholder. The other two big shareholders are Vanguard Group and BlackRock, which are like large asset management companies. Like they have ETFs and funds that hold GameStop within it. But Ryan Cohen is all in, right? Like this is the big bet that he's taking. So he's going to do everything that he can to increase the stock price of GameStop. He's not taking like a salary, which he calls like risk-free payment or income. Like he's doubling down on like he wants to be he wants his compensation or his value to basically be driven by the performance of the stock and performance of the company. So he's very much incentivized to like ensure that the company does well. At the same time, Roaring Kitty also disclosed his position, which is something like $350 million worth of shares. It's a very concentrated portfolio, but it's all in GameStop. And how did an individual investor like Ryan Gill, I think I called him Ken Gill, apologies for that, Ryan Gill, how did Roaring Kitty accumulate or amass such wealth? That's pretty impressive. So you've got, so he essentially, Roaring Kitty through his live stream kind of got people to start looking more at the company's fundamentals. And I mean, yes, the stock price is one thing and the trading volume and all that, the short interest and all that is part of it. But I mean, I think if you're a long-term holder, you're interested in to see what the company's plans are. And I think one of the big news that the company announced, GameStop, was that they're issuing new shares, 75 million worth of shares, and they're going to be selling these shares. This is an option to sell the shares at the market price. And they've retained a company called Jefferies, which is a sales agent. And Jefferies' commission is 1.5% of the gross sales price per share. So what does this mean? So essentially what's going to happen is GameStop is going to issue 75 million new shares into the market, right? So they're going to add more shares into the market over time. They won't do it all at once. They'll be able to pick and choose when they sell shares, and they'll sell the shares at the price where the stock is trading at that time. And Jefferies is going to be managing that. So they're going to be following along these price movements and looking to time it or looking to place those sales so that the company gets the maximum proceeds. Also because Jefferies is incentivized from commissions, 1.5%, right? So they're getting 1.5% of the gross sales. So it's in their interest to make sure that they sell at a high price, as high as possible. $75 million or 75 million shares at the current price per share of roughly $28 essentially comes out to be about $2 billion. So the company can be significantly increasing its balance sheet through this sale of shares, right? So that's a pretty important tidbit. All of a sudden the company is about to raise a ton more funding, and with that funding, they're going to go from $1 billion in cash to up to $3 billion in cash, right? And so that's going to give them a lot of flexibility to grow the business. They can do things like investments. They could potentially acquire companies. They could expand their retail footprint. They could do lots of different things, right? They have so much flexibility. It's not like they need the money necessarily to survive as a business, because although they're losing money, they're not losing too much. They're just barely losing money. So they're almost at break even. So with a few optimizations in the company's operations, you could potentially get back to profitability. And on top of that, you're having huge new balance sheet that you just bolstered. So what I've done here is I've got my portfolio here where we can see some of the fundamentals illustrated, the stock price, as well as the cool new ticker chart, candlestick charts. So that gives us the ability to do some technical analysis. We can do the fundamental analysis as well. And with my new chatbot assistant that I'm developing here on the right-hand side, this is going to allow me to understand more of the corporate documents, the forms, the filings, and sort of the management team's prospectus and kind of what their plans are for the business, right? So we're looking at it from all angles. And so what I've done is I've added all of those forms that the company files with the SEC and makes them all these forms publicly available. And these documents are very long. You have your annual statements, your 10Ks, you have your 10Qs, your quarterly statements, you have your quarterly reports, you have your proxy statements. These are 75 pages, 50 pages, 40 pages, right? Plus you have the quarterly results. So you've got all this information that you have to wade through, and it can be kind of overwhelming if you don't know how to like read an income statement or a balance sheet. So what I've done is I've added those items into my RAG, and then I started asking some questions to help me figure out what the bull case for GameStop will be. Like, we'll try to arrive at what I think could be an intrinsic value, and what's the like longer term story for this company, right? Like, what can we say about this company? Like, is this company trending in the right direction, or can they turn it around? Like, so let's go through some of the questions I asked. So the first thing I said was, as of the latest quarterly report, how much cash and liquid assets does the company have on hand? And it pulled the right information. It has just over $1 billion in cash and cash equivalents. So things that are almost like cash, you can turn it into cash. So that gives it essentially the runway to operate. Like, this allows them to use that cash to finance their business operations. And since the company is losing money, kind of, it's just barely kind of like operating at a loss. The cash it has on hand is, assuming the company doesn't grow any further, it just continues operating as is. It gives it like I don't know, a 10-year runway. So that's pretty good. But obviously that means that's only if it doesn't like spend this money. So that's why I think they wanted to raise even more, so they have more flexibility. Like, you want to preserve your existing runway, but then you also want the flexibility to do even more, right? So they have the $1 billion there, which gives them roughly 10 years of runway, 10, 11 years of runway. Essentially meaning like how long they would be able to continue operating, assuming nothing else changes in the business, but still making a loss of, probably like, I think it's like a $60 or $70 million loss per year. I think that gives them some time. Plus now they have the flexibility to raise even more money, which could give them a few extra billion. So let's say they have $3 billion. That gives them a lot of flexibility. How many total shares are outstanding? I wanted to double check that the market capitalization is correct, and I could verify that here. So yeah, the capitalization of the company is about 8.6 billion at the latest price per share. So for a company that has $1 billion in cash, you want to know what other assets it has on the balance sheet aside from the cash, right? Because we're trying to figure out what the intrinsic value of the company could be. Like, how much is it worth if you sold all of its assets and you liquidated the entire company and you returned all the cash to the shareholders? How much could you actually sell everything in the company for, liquidate it completely? And that's where you need to understand what the total assets are on the balance sheet. And it came back, the chatbot searched through all these documents that we talked about before, all the filings, and looked through all of the financial statements, and it came up with a figure, and it says like the total assets is around 2.5 billion or so, 2.7 billion approximately, right? So it's got between 2 and 3 billion in total assets. And what the big chunks of those assets are in the merchandise. That's a big chunk of it. That's like the largest pool is merchandise. So that's the games, the game consoles, the toys, the collectibles, the other things that GameStop has, right? So that's a big chunk of its assets. The unsold inventory that it still has in its stores, right? So if you sold out everything, that's what they account. That's how much they sort of book the value of those inventories at, 600 million. The other asset is a little bit of a tricky one. This is the operating lease. So its retail footprint. So GameStop probably doesn't own the real estate that it operates under. It's probably part of a mall or a strip mall. It's a tenant within a larger complex, but these leases can be thought of as an asset because it essentially gives them the value. It gives them the option of, or it provides them the ability to monetize from being in busy commercial districts and in like shopping centers and that kind of thing. So because that's limited space, that can be, I guess, considered a type of an asset. Other than that, they also have marketable securities. So those are things that you could convert into cash, I guess. So that's its assets, 2.7 billion. So already, if you look at the market cap versus the assets, it's trading at a premium. So there's definitely the current investors believe that it is worth more than just the assets. It feels like it has some brand value. The equity, there's some equity in the brand, and like it should have a premium. Maybe because of like its place in the market, or for whatever reason, that's just how the market sees it. Now the short sellers might say, no way that this company can be worth 8 billion. Look at the actual sales, look at the profit. It's not even making profits. How can you value it at anything more than just its cash, right? So they probably think that the company is only worth maybe 1 billion or 2 billion, right? So there's this dichotomy between the two sides, between the bulls and the bears in this company, right? So that's why you're seeing, when it got down to the $10 price, that would be like about a third of what it is at 8 billion. So it would have been probably around, closer to the total asset price, right? So now, but we also have to factor in the debt. So it's not just the assets. We have to understand what kind of debt it has. So I asked, what debt does the company have? And the good news about GameStop, it doesn't have a lot of debt. It actually has very, very manageable debt. Aside from debt, there's other liabilities, and in that case, they do have hundreds of millions in payables, so they have to pay this out. And they have like the lease liabilities as well. So these are things that it still owes on the existing leases potentially. Operating lease liabilities. So it does have some liabilities. So if you minus the assets from the liabilities, so you got 2.7 or so, 2.5 minus 1.3 billions, then you're just right around a little bit more than the cash. So it's like the cash plus the merchandise plus a few other things, right? So in that case, then the company, if you're just looking at it like from a very pessimistic, we have to just sell everything and just like what's the book value, or what's the value of the company, then you're looking at a company worth probably less than 2 billion, but, or just a little bit more than the value of its cash. But that's not how accounting works, or that's not how markets work. Like you can have debt on a company, and it doesn't necessarily, it's, this is not necessarily how we value companies. Not every company is just valued purely on this cash that it has. There's other factors that go into it, like growth rate and other things. But definitely in the case of GameStop, you have a class of investors who want to support the company. And in addition to just being a customer at the company, they're also wanting to be a shareholder. So they want to hold the shares and not sell the shares and make the price go down, but actually buy more of the shares and support the price, which is kind of like what people think is is like a risky thing to do. But I mean, these people really believe in the company, and so that kind of gives this business a bit of a premium, where it's like you can't just value it purely on pure fundamentals. I think not in this case, because then it just wouldn't make sense. But I wanted to ask what the 412 million in accrued liabilities could be attributable to, and it sounds like there's customer-related liabilities, some deferred revenue, benefits for employees, and so I think some of that is probably things like stock options to employees, and also things like deferred revenue and liabilities related to customers. Might be their loyalty program. I think they probably have points that they issue or give people, or discounts and stuff, which you have to account for, and so that's probably what that is. So the deferred revenue means like those are the points that they gave people, and the people haven't. Maybe the liabilities are the points that they gave people, and the people haven't purchased those yet, or cashed those points in. So you have to hold that as a liability. And the deferred revenue may be things like gift cards that people buy. So when they buy the gift card for $100, they pay GameStop in advance, but they get a gift card on their side. So on one side of the ledger, you're getting the cash, but on the other side of the ledger, you still have to account for that gift card that wasn't spent yet. So I think that's what these two things are. I think it's their points program and their gift cards. Could be wrong, but then I wanted to ask, like, how profitable is this company? Like, help me understand the margin profile. And it gave me a cool breakdown. It said, like, although GameStop is working towards achieving profitability through strategic cost optimizations and aligning their cost structures with anticipated future needs, they are currently not profitable. For the last quarter, GameStop's margin profile includes the following. So you have the revenue, the cost of sales, the gross profit, then you have selling, general, and administrative expenses, and an operating loss and a net loss. So on an adjusted EBITDA basis, the last quarter, they lost $33.8 million on revenue of $1,237 million. So you got $1,237 million in revenue, but a huge portion of that was your cost of sales. What this tells me is that, especially in the video game industry, like the price of a PlayStation, of an Xbox, and of like FIFA, Madden, Call of Duty, like the price is pretty fixed across all the different, whether you go to Best Buy, Amazon, Target, wherever you buy these games from, you're not going to get a huge, like the price is the price, and there's almost no margin for that. So it's pretty competitive. Like especially gamers, or video game players, like they quite understand like how to shop for games and stuff like that, and like there's almost no difference in price. So that means that like the cost of sales in this case is like GameStop has to buy all of those PlayStations and Xboxes to stock their stores and all those games. And they might get a little bit of margin by buying in bulk, or like by reserving those products from the manufacturers, from Sony and Microsoft and EA, Electronic Arts, and Take-Two Games, and Nintendo. But like there's no markup that they can apply to it, because like it's too competitive. Like Best Buy, if your price is significantly higher at GameStop, like no one's going to buy it. They're going to go to Best Buy, they're going to go to Target, they're going to go Amazon, right? So you have to kind of like, you have to find other creative ways to make margin. And that's where I think they introduce other things like toys and collectibles and programs and memberships and stuff like that. It's like, because it's so competitive and there's like no room for discounts, and like, there's no margin to play with there. So that's why GameStop is in a very low margin business. Now, part of what can also like contribute is selling, general, and administrative expenses. So in this case, like their gross profit is 287 out of the 1.237 billion, 287 million. So you got a couple hundreds of millions in gross profit, but that's before you subtract your like business expenses, like paying staff, spending on marketing and everything else like that. You have to pay like credit card processing fees and other things like that. So all of that is actually causing the company to lose money. Now, if they can optimize this line item, then they can potentially turn a profit. But the cost of sales is probably going to be it's always going to be the function of gross profit is always going to be a function of revenue and cost of sales. And because of the types of products they sell, it's not probably going to change much. So their biggest lever is going to have to come from optimizing selling G&A expenses, which is their internal operations. And that's what the chatbot is also saying. But part of that is like salaries, right? And Ryan Cohen could be the most highly paid employee because he's the CEO and the chief executive officer, president, and the chairman. But he's actually declined all forms of salary. So his no benefits, no salary. I think he's already a billion. He might already be a billionaire. So he's basically playing for those shares, right? He wants his stock to appreciate, and the way to do that is to just make GameStop super efficient and growing again. And he'll be rewarded by his portfolio expanding in value. Now, we wanted to know what would happen if we talked about how one of Ryan Cohen's mission since becoming the CEO is to like turn the company around, and part of that is he's going to raise funding. He's tapping the capital markets. He's going to issue new shares, which is not a common thing that companies do typically. Typically, they don't want to do this because it dilutes everyone else, and it could be seen as a negative sign. It could be seen as the company is like needs cash to survive. But in this case, he's being opportunistic. He's seeing how the stock price has rebounded, and he's realizing that there's some support that he can potentially get from the shareholders, and so he's going to issue new shares. What this is going to do, it's going to increase the total share count, and it's going to dilute his ownership from about 12% where it is right now to less than 10%. So his percentage of the ownership of the company is going to go down a bit, but hopefully that the cash that he can raise for the company can be put to good use, and that can increase his value. So although his share count goes down, or his percentage of the overall company drops from 12% down to less than 10, just under 10, hopefully the share price, I mean, in his eyes, he wants the share price to increase substantially more than the dilution that he's taking. Now, we're trying to figure out what GameStop's value is, right? So we know about the cash and we know their business model margin, but what about its retail footprint? And it looks like it has 4,000 stores across the world, mostly United States, vast majority US, also Canada, Australia, and Europe. And they also operate some other boutique stores like Zing Pop Culture and EB Games and some other ones. But it's pretty much it's in this niche, right? Like GameStop, it's in the name. It's like, okay, it's obviously catering to a very specific type of demographic, and they're gonna want to like cross-sell and upsell those existing customers as much as possible, and possibly even figure out new customers that they can, new markets that they can enter, or how can they expand the pie basically. Because yes, those collectible cards like Pokemon cards and like, video game character toys and collectibles, like there's probably a big overlap between people that play video games and want to collect the characters in those games and stuff like that. So that's what they've been doing. But I almost wonder like what else that they could do. Like, could they partner with, because they have this retail footprint, right? They have all these stores, and the stores kind of give you a form of marketing because you want people to think about GameStop more, right? Like, because the normal customer is not going to come in every week to buy a game. It's just not going to happen. Like, they'll come when there's like a big game release, like Madden or FIFA, right? Every year there's a new one, or there's a new Halo, there's a new GTA, right? There's some new release on the calendar schedule. That's when they'll come into the stores. But like all the other days where they're not coming into the stores, you kind of want to like engage with those customers in some way. You kind of want them to transact with you. So you need to create more ways for them to spend at your stores. You've got this retail footprint. Presumably you're in high traffic areas where people can see your stores. So you should take advantage of that. You should take advantage of your employees having being brand ambassadors for you, right? Like, they would be sort of your brand ambassadors, in a similar way how like Uber drivers has a huge, like, their employees aren't necessarily, I mean, their people on their system aren't necessarily employees, but it has this positive flywheel effect because like you can be both a rider and a driver. And I think if GameStop can think of I'm kind of like just brainstorming here, but I wonder if they like partnered with like a DoorDash or an Uber or something, like somehow did some tie-up whereby they could get more visibility. Because I bring up DoorDash and Uber because those are like high frequency types of transactions, right? Like people order food all the time. They ride on cars and take trips and travel all the time. So Uber, DoorDash, Instacart, they have like a high turnover, like a lot of repeat buyers, right? I think GameStop probably has more like lumpy sales cycles. Like you might have people who buy like a game and then play it for a while, and then like after 2 or 3 months they go back and pick up another game, or like I guess I'm just trying to think of how GameStop could become more of like a high frequency retail outlet for something. Maybe they could sell like convenience store snacks. Maybe they could do a tie up with like Pepsi or Coca-Cola. And so like when Microsoft launches the new Halo and they do some like Mountain Dew brand, or they do some kind of like Doritos or Cheetos, like, or like Nintendo, like they introduce like Super Mario Cheetos or something. Like, I wonder if, GameStop, since they do have retail location, I wonder if they could offer snacks as a potential cross-sell or upsell, higher margin thing. I don't know, just thinking out loud. But yeah, I think they'd want to like take advantage of their retail footprint and think about how they could monetize that a little bit more, because that is one of their biggest costs, is their lease. And if they can figure out how to get more revenue per store, that might help. But you don't want to get into like having to prepare food and all that. That's probably out of scope. But definitely thinking of like, how do you become more visible? How do you like get more people like as your brand ambassadors, either as part-time employees, full-time employees, or how do you like get your brand on other popular apps through some kind of partnership, like whereby people can order a meal and also pick up a game on the way to deliver it or something like that. Like kind of bundle that in. Just thinking out loud, but that's up for Ryan Cohen to decide, and he and the management team will figure out what to do with that use of funds. But yeah, looking into the company a little bit more, what are the primary costs for the business model? It's almost entirely on the cost of sales, which could be things like the products that they buy, obviously those PlayStations and Xboxes and the games themselves. And then you have the selling and general administrative that we discussed, advertising, you have other things like that, right? So those are like, it's a cost intensive business. They have to figure out how to get more margin, how to become more profitable, either on a per store basis, on a per transaction basis, how they drive down their advertising through leveraging their footprint. How do they do like win-win partnerships whereby like they can get kind of free advertising, or can they get other companies to pay some of their advertising costs? So those are the things, you have to be kind of creative in how you do that. Then I wanted to know, what was the company's planned use of proceeds from the at-the-market offering? So assume they sell these 75 million shares over time, and assume they raise $2 billion plus the $1 billion that they already have. What are they expected to do with that $2 billion? Have they laid out a plan? And it says, like, from the filing, GameStop is basically saying that they're going to use these for what they call general corporate purposes. And that's sort of a catch-all term to say, like, they could do acquisitions, they could do investments, they could just do more marketing, they could expand the retail footprint. So pretty much anything that the company normally would be doing, they're just having extra funding to continue doing that. So it's not a very specific, plan. It's kind of giving them the flexibility and the option. Also, because like they don't have a set schedule on when they would sell those shares. They're getting the prior approval to sell up to 75 million in shares, and they have a sales agent who will help them get the best price for that. So they're going to be raising money, which is a bullish thing, I think. However, we want to know, like, if after they sell these new shares, like, how would that affect the dilution? What would the expected response be from the market? Like, after this selling, like, what would happen? And so it explains here, like, how the dilution of existing shareholders would go down. So, for example, if Ryan Cohen currently holds 12% of the company, issuing 75 million new shares would reduce his stake to 9.67%. So I think 75 million of 305 existing is about 25% new shares. So it's pretty substantial. It's like bigger than like an IPO in some sense. It's pretty big. As you add more shares, your earnings per share goes down. Potentially, if you don't have more earnings, because you have more shares. So your earnings per share, let's see, how does that work? So they're spread across a larger number of shares, right? So potentially reducing the earning per share if the additional capital is not immediately accretive. Yeah, right. So it might look temporarily like the company is less profitable on an earnings per share basis. But from terms of the stock price, the immediate selling pressure might temporarily drive the stock price down. The perception of value, how the proceeds from the offering are used, can affect investor perception. If they're used for value-enhancing projects or investments, it could mitigate some of the negative price effects. Yeah, exactly. That's what I'm thinking as well. So like, it's interesting because like on one hand, you're issuing new shares which dilute, you're raising capital which is good, but you're selling shares which kind of drives the price down. But with that capital that you're raising, you're kind of investing it back in the business, which could make the stock go up. So it really depends on how the market sentiment is, how people view it. And I think that's probably bullish if you are a long-term thinker on GameStop. Like this definitely eliminates the company's like short-term liquidity problems and gives them a lot of flexibility. So that's kind of bullish. They have increased capital and that can be used for long-term growth. So I took all of that and I said, based on the above, give me the bull case and the bear case for the company's stock. And the cool thing about the assistant, the chatbot, is that it was able to do that. It gave me the bull case and the bear case, and it's basically what we discussed earlier. It's like if you have effective use of those proceeds, you're using that money to fortify your balance sheet. You're giving yourself more optionality. You could buy companies. You could make investments. You have more money to do different things. And if you time it right, and there's like a new like upgrade cycle for the Xbox and PlayStation, or a bunch of new games coming out that people are going to want to buy, that could be a good use of your funds, is to like draw more interest and more customers during this time. So that's interesting. If they invest more in technology, maybe that helps them drive their SG&A costs down a bit, right? So the cost optimization can help their margin profile. And if the market overall thinks like you now are, in a stronger position, then that may give more investor confidence. The bear case, of course, is as we discussed. If you're looking at it purely fundamentally, you're diluting the existing share base, and your earnings per share could be impacted. The other bear case is like there's an execution risk, right? Like if the CEO and the company's management can't capitalize on this, then that would turn investor sentiment sour. You also have market and competitive risks, but I think while GameStop does face a lot of competition from other retailers, it does occupy a pretty like defined niche, whereas Target and Best Buy do offer some of the same products that GameStop does, and obviously Amazon does. And then, of course, you have the console manufacturers themselves, the PlayStations, Xbox, and Nintendos, who sell their games directly. I think the big purchase, or the top products for GameStop from their perspective, like the bulk of their revenue probably still comes from those consoles. So buying the physical Xbox, the physical PlayStation, you still need to buy that. Beyond that, the products get distributed digitally for a lot of video game players, but those hard drives eventually fill up, and so at some point you might want to have physical copies of those games, and then I think that's where GameStop still has a long, and I can see them having a longer term story. I believe that the digital downloads are not going to make GameStop obsolete, or I think because you always run out of space eventually, and some people really like to collect things like physical discs and CDs and records and stuff. So, I think there's still something about a tangible game that people like. So, in conclusion, I think there's definitely a bull case to be made for the company. There's also the existing bear case that it's just overvalued. But I think for the most part, this was like a good example of how, when you look at the company, not just from the reported financials, which is looking at it from a historical perspective, and not just looking at it from technical chart patterns, but also understanding what the company is planning, what kind of forward-looking statements they're making, how are they planning to execute, what are those corporate events like earnings releases and and share issuances, those kinds of things. Taking all of that into consideration, into account, can give you a much more broad and comprehensive picture of how that company's operating and then that allows you to kind of have a view on how the market will receive those things. And then you can decide whether or not you want to add this company to your portfolio. And that's where I think our platform comes into play. It's because you can basically this is like Microsoft Flight Simulator, right? For stocks. You don't have to risk anything. By using our platform, it's completely free. You don't even have to spend money to buy or sell these stocks to add them to your portfolio. You can just add them to your portfolio and track them. And I think you get better by trying and doing and practicing. And that's what our goal is, right? We want to make investing more approachable. We want to give more people access to this form of wealth building, which I think is really, really important, right? I mean, there's a lot of people look at trading and especially the GameStop meme stock frenzy as sort of like gambling. I think there's some element of that, and some people do look at it that way, like it's just a bet. But I think if you look at it more holistically, and you can build a thesis around bull case, bear case, what the short, medium, and long-term price trends are expected to be, and how well all that is based on investor confidence, right? And it's like how confident you are in management team's ability to execute. But I think if you look at it from the perspective of GameStop, their CEO, Ryan Cohen, seems to be doing the right things. And then you also have some really high-profile shareholders who are out there kind of like being your brand ambassador. And there's the roaring kitties of the world and so forth. So I think actually, who knows? There might be a bull story here for GameStop. Do your own research, I'd say. But anyways, that's kind of I'm not giving you guys any recommendation or buy or sell. Like, do your own research, definitely. Like, make your own decisions. But I just wanted to present maybe the other side, because I think what gets lost in a lot of the noise around just the trading of the options is like, fundamentally, is this company, like, does it have prospects? And I think that's kind of what we should also look at, beyond just the intraday stock price movements. Oh well, that's all I wanted to say for today, guys. I hope you enjoyed this look at GameStop, diving deeper into some analysis, looking at the corporate filings and those forms and official documents, looking not just at technicals, not just at financials, but also in the prospectus of the companies and their forward-looking statements. And I hope this was enlightening for you guys, and looking forward to seeing you guys on the next one. Take care. Bye.